Hey, welcome to the Explainer. Today, we're going to dive into something we all see now: commission-free trading. I mean, it sounds amazing, right? A modern miracle, even. But is it really free? Let's dig in and find out.
Yeah, that's the big question, isn't it? Every single time you hit buy on one of those quote unquote free platforms, your order goes on this surprisingly complicated journey. And guess what? That journey has a cost. The real mystery is who's footing the bill?
All right, so let's get right into it. We all know the drill, right? You open up an app like Robinhood, Schwab, or E-Trade. It's super fast, couldn't be easier, and right there in big letters, it says zero commission.
You tap that button and bam, instantly you own the stock. It honestly feels like magic. But what's really going on behind that simple click? Well, there's this whole hidden machine cranking away in the background. And if we want to figure out the real price you're paying, we've got to understand how that machine works.
So, to really get a grip on today's market, we actually have to take a step back in time. We need to look at let's call it the original sin of gaming the system. It's a practice that's been around for a long time. It's called front running. And just to be clear, it is totally, completely illegal. It's basically a type of insider trading. The whole idea is that a broker gets wind of a client's big trade, and they use that secret knowledge to make a buck for themselves, at their client's expense. So picture this. A huge fund wants to buy a massive block of some stock. Their broker gets the order and thinks, whoa, this is going to move the market. So what do? Before placing that giant order, they sneak in and buy some shares for their own account. Then they put through the client's huge order. The price spikes up and boom. They immediately sell their own shares for a quick, basically risk-free profit. It's textbook profiting from private info, and it directly hurts the client they're supposed to be serving. And you gotta love where the name comes from. It's so literal. Back in the old days of paper tickets on the trading floor, a broker would get a big order from a client and would literally, physically run to the trading desk to place their own order first. It was a real, actual race to get in front of the client's trade. Wild, right?
Okay, so that's the old school way of doing things. But today, the game has completely changed. The action isn't on a physical trading floor anymore. It's all moved into this new arena, this digital world dominated by these massive, high-speed electronic players we call wholesalers. And this is a really crucial point. When you hit buy on an app, your order probably isn't zipping straight to the New York Stock Exchange. No. Instead, your broker takes your order and sells it to one of these giant firms, a wholesaler. And they are the ones who actually execute the trade for you. And this market is super concentrated. You've got these huge players like Citadel and Virtue that handle a mind-boggling amount of trades from people like you and me. But look at this chart here. You can see that E-Trade's mix of wholesalers looks way different from Robinhood's. And that decision, that choice of where to send your order, that's called order routing. And believe me, it is right at the heart of this whole story. So brokers have basically two main ways of doing this. First up, you've got proportional routing. This one's pretty simple. The broker just carves up all their orders and says, okay, 30% goes to Citadel, 25% goes to Virtue, and so on. Everybody gets the same general mix of trades. But then you have selective routing. This is a lot fancier. A smart router, some kind of algorithm, actually decides on a stock-by-stock basis where to send the order, trying to find the best price in that exact moment. Okay, so all of this brings us to this really fascinating academic study. These researchers basically acted like detectives. They wanted to answer one simple question. In this whole new world of wholesalers, are everyday investors really getting the best possible deal? And here's the cool part. They didn't just sit around looking at spreadsheets of old data. No, they ran a massive, real-world experiment. Get this. They placed over 150,000 of their own trades, all identical, placed at the exact same time across 6 different brokers. They did this for almost 2 years. It was a brilliant way to directly compare the prices each broker was getting for the very same trade at the very same instant. Now, you'd think this would all be pretty straightforward, right? I mean, brokers have a legal duty to get you what's called best execution. So common sense says, if one wholesaler is giving them better prices, they should send more of their trades to that wholesaler. Simple. It makes perfect sense. But is that what they're actually doing? And this right here is the big aha moment from the whole study. This single quote flips everything we thought we knew on its head. I'm going to say it again because it's that important. Wholesalers charge higher prices because brokers are already sending them a ton of orders. I mean, that is the exact opposite of how a competitive market is supposed to work. So here's the puzzle, laid out plain and simple.
For those brokers using that basic proportional routing, the more business they gave to a wholesaler, the higher the cost got for their customers. Just bonkers. But for the brokers using these selective smart routers, more business meant lower costs, the way it's supposed to work. So what on earth is going on here?
Well, the researchers have a theory. They call it switching costs. The best way to think about it is like the hassle of changing your cell phone provider. You might have a contract, you have to get a new SIM card, transfer your data, to pain. It seems that for some brokers, these frictions, the contracts, the tech setups, just plain old inertia, are so high that the wholesalers basically know they have a captive audience. And when a company knows you're not likely to leave, well, they can get away with charging you a little bit more.
Okay, so we've covered the history, the modern market, and some pretty mind-bending research. Let's bring it all home. What does this all actually mean for you and your money? 34%. That's the big number. The researchers ran a simulation. They asked, what if all the brokers just actively sent their trades to whichever wholesaler gave the best price last month? The result? A potential 34% average improvement in the price you get. To put it another way, that's a 34% drop in the hidden costs of your so-called free trades. That's huge. And it's not just a theory. We have real-world proof that more competition is a good thing. A few years back, a new wholesaler called Jane Street jumped into the ring to compete for Robinhood's business. And something incredible happened. Not only did Jane Street offer really good prices, but the big guys, Citadel, Virtue, they suddenly had to lower their prices to stay in the game. Just the threat of losing business was enough to force everyone to give everyday investors a better deal. So, at the end of the day, what's the big takeaway? First, commission-free isn't actually free. The cost is just hidden in the price you pay for your stock. Second, it turns out a lot of brokers are pretty passive. They're not always chasing down the absolute best deal for you on every trade. And that inertia, that lack of intense competition, could be costing you money every time you click buy.
And that leaves us with one last big question to chew on. In a world of high-frequency trading and mind-blowingly complex algorithms, in a market measured in millions of a second, is the legal requirement of best execution really good enough? This research seems to suggest there's still a long way to go.